One of the things that we spend an extraordinary amount of time doing is finding the best and the brightest investment managers in every asset class in whichever corner of the world they may be hiding. And I can tell you just from experience, one thing for sure is that finding top talent, true talent, is a lot more difficult than it seems. But for our next speaker, he has turned this search for investment talent into somewhat of an art form. So Donald Sussman, who we are privileged to have with us, just to give you a little background, he has been investing in hedge funds for more than 30 years and is the founder and chief investment officer of Paloma Funds. Last year, Donald was named to the Institutional Investor Alpha Hedge Hall of Fame and was the recipient of numerous awards in both the hedge fund industry as well as for his philanthropy. Donald is deeply committed to giving back, and his many philanthropic involvements have included Carnegie Hall, where he sits on the Board of Trustees and chairs the investment committee, the MIT Sloan School of Management, Skidmore College, and many others. What is perhaps not in Donald's formal biography, and this is actually how Donald was introduced to me, when I was told about him, the words that were used is, this man is the granddaddy of the hedge fund industry. So I hope you don't take that in a pejorative context, the granddaddy thing. But having seeded some of the best-known hedge funds in the world and cultivating stars like Nassim Taleb, David Shaw, and to achieve the prominence they enjoy today takes unique talent in and of itself. And it is with great pleasure and privilege that I present to you Donald Sussman to share some insights on finding investment talent. Thank you.
Thank you. Not mentioned and not to speak about, I've gotten 3 Lifetime Achievement Awards, which means I must be in my afterlife now. Josh Friedman was kind enough to mention afterwards, we actually gave Canyon their first money, among other people we gave money to very early on in their careers. Let me, since my 30 minutes got compressed to 19 and a half minutes, let me, I will, in a way, try to cut to the chase. So what I have found over the 33 years we've managed Paloma is that you need to have the right time in the right cycle with the right people, that there is no strategy that is good all the time. And the unfortunate thing for most investors is you don't have what we have, which is transparency into all of the transactions going on in our traders, a risk management system that lets us analyze the risks that we're taking and hopefully offsetting within our portfolios. And we're able to shift on a day-to-day basis how our money is allocated. So I'm going to try to start, assuming this thing works for me better than other people. So this is, before we conceived of this chart, which I now call the finger painting chart, one of our clients asked us, well, could you show us what your asset allocation looked like over time? And we had no idea what this was going to produce, and we just took the data, crunched it, and there it is. And what it will show you is what you can't do that we can do, which is every day we can shift around our portfolio to those assets that are looking the most opportune. So when Byron was talking earlier about recycling yourself, we do all the time because we are constantly in the search for new talent. And this chart is only 10 years worth, so we don't have Canyon Partners in here, but they were one of our early investments. What's happened now is a complete change in the investment landscape, which Josh alluded to in terms of who the players are, how much money they have, what they can do, what their regulations are. And so we at Paloma are in the unique, and I feel like the culmination of a lifetime of work of getting here. We are in a unique position to attract talent that is coming out of the really secret sides of big financial institutions where they had businesses that were, without taking risk or minimal risk, were producing very, very high rates of return that banks were trying to hold on to during the purge of the Volcker Rule. So the Volcker Rule, as you all probably know, has taken banks out of the market-making business and out of the hedge fund business, and we are one of the people that are the beneficiaries of that. So we have the greatest pool of talent and are attracting the greatest pool of talent we've ever had. But primarily, like Josh, we're very concerned about credit risk. We're very concerned about interest rate risk. With this finger painting chart, we have produced a rate of return equal to equities, slightly better than equities over 33 years at 1/3 the risk. And the way we've done it is by not taking big risks at any time. It's not like we've been particularly brilliant about forecasting movements of equities or debt or anything else. It's that we look for arbitrage opportunities where we can lay off the risk at all times. So this is a particularly hard time as an investor not with this capability to take advantage of these things. Unlike Byron, who's very sanguine about the state of growth in the world and equity markets, I'm very concerned that deflation is picking up in Europe and that the gridlock that we've observed in Washington is nothing compared to what we're going to see in the next 2 years. And equity markets, the reality of the American equity market is that equities have returned 9 times as much during Democratic administrations as they have during Republican administrations. And what we're about to see is something that looks like a Republican administration. So I'm particularly nervous about equities. I think those people who are sanguine about having had money in index funds and other varieties of equities where you could just sit back and you've clocked along at a pretty good rate of return for the last 3 years, I think we may be in for some serious shocks. So we are always hedged. We try to keep all of our exposures to truly market neutral, and that's been the story of our success. Let me flash back here if I can. So in this slide, we talk about you have to understand why people are leaving. They don't typically go for economics. To shorten what I was telling you, what's going on right now is a complete regurgitation of volatility traders. That may mean nothing to you, but over the last 3 years, the volatility of equity markets and debt markets have been at all-time lows. So people that have been trading these strategies have essentially fired all of their really talented people. We've just started hiring them. The early wave of money managers that left banks were one set of good quality people. What we've had in the last 3 or 4 months is the talent that has been kicked out by the law firms who are now going through banks with fine-tooth combs, getting them out of their secret little pockets of really high rate of return strategies, and they're coming to us. The other thing I think that's particularly important is it's impossible now to start a hedge fund. For most of my business career, the number of calls we get in any given week is astronomical from people who'd like to be seated by us. And long-short equity is a business I've never been enamored with for a whole variety of reasons, not for today. I would send people that would come to me with that kind of strategy to one of my friends in one of the back offices of one of the firms and say, set this guy up, give him a good deal. If he's good, he'll attract money, you'll have a great client. You can't start a hedge fund with less than $250 million now. That's no longer friends and family, which means the genius that's sitting in the corner of someone else's fund, some guy who works for Josh who thinks he's smarter than Josh and wants to go out on his own, he can't do that anymore. He's got to come to some platform like ours. So we are not only seeing the best of the Dodd-Frank recruiting, but we're seeing the best of people who are the normal cycle of people in the hedge fund business who dream up a great strategy. They're a little person, low down on the totem pole. They want to go out on their own, and they basically can't without us. So this is really, a great time in our history. So one other comment that Byron made that I thought was spot on. He said, try to find out back before the person you're interviewing was 17 years old, what it was that will cause them to be either risk averse or not. So I'm frequently asked to talk about recruiting talent, having started Caxton, D.E. Shaw, many other very big investment firms, all of which we got out of after 5 or 6 years. So what is the secret formula of the question that you're asking? And the truth is I'm a very good listener. I don't ask a lot of questions. I typically ask people, how do you make money? And that's the only question. Then I listen to what they have to tell me. What they don't tell me is more important than what they do tell me. But of the things they tell me, at some point they have to explain to me how much they hate losing money. That is the key to our business. We hate losing money. There's no more stressful time in our shop when we have a bad day. We don't make money every day. Things go wrong for us like everyone else in the business. It's the market. But we are all over everything that loses us money in an instant. And a new potential investor, I knew the guys from Canyon from their world when they worked for Mike Milken, who was someone we would never do business with because we didn't like his ethics, but they were very smart. And they were always about getting the documentation right so that they had all the advantages in whatever they were doing. They were all about being risk averse. And that is true that everyone that comes to work for us. Okay, now I'm having everyone else's problem. Let me get you to one more. Oops, there was a slide missing there, sorry. So another comment that Josh made was about how banks are no longer making markets in bonds. That's also true in equities, derivatives, everything else. So the 3 areas of focus that we have now is, one, there is still a tremendous amount of opportunity in what we call credit relative value in the residential mortgage space, in long-short corporate bonds. There's still a lot of dislocation in that. We have one trader who does nothing but trade in between market makers because spreads are so wide without taking more than 2 or 3 day risk. It's especially true in the equity markets, and we have increased our allocation to what we call algorithmic trading from a low of, we've been in this business since 1985. We started David Shaw in 1988. We know this business very well. It got down to 5% because during the era 2002 through 7, the major banks had become so good at it, there was no money to be made at it. But now they're out of the business. And so profit margins have never been bigger. And what we're really doing is becoming market makers in equity securities, but we have actually 10 million positions on. So it's similar to owning a casino and letting all the other money managers in the world trade equities against us, and we are constantly laying off the risk of the supplier demand that they need. So that's our favorite business. It doesn't take market risk. It fits my new macro strategy, fearful that we're in for a real equity problem in the US, and it's a very high rate of return business when it works well. Over time, we've made about a 15% rate of return doing it. So I think I'm going to stop with that because you actually have one of my business partners is going to come up and talk about China, and I think we'll use the time to get into our other session, unless there's some questions. be risk averse. Great. I do. Wait, fire away.
All right. Well, first of all, thank you, Donald.
My pleasure.
In that case, you're welcome to have a seat and take a load off while I introduce Paul and Paul Wolansky and Michael Dennis. So, Paul Wolansky, who has, as has been said, was seated by Donald, is the founder and chairman of New China Capital Management Corporation and Cathay Capital Holdings, one of the earliest and most successful family funds undertaking direct investment in China. Cathay's investments have ranged from auto insurers to natural gas pipelines to fashion magazines, and Paul has served on the board of directors of all of Cathay's principal portfolio companies. And previously, Paul was managing director at none other than Paloma Partners. Paul, I don't know where you are, but if you could please invite you to the stage. Next, we have Michael Dennis. Michael Dennis is the chairman of Azure Partners, a firm that has acquired over $500 million of apartment projects and has developed some of the largest commercial projects in cities like Toronto, Toronto and London. Prior to Azure, Michael headed Olympia and York's development activities in New York. He developed major commercial buildings, including the World Financial Center. And Michael also served as the CEO of Canary Wharf, the CEO of Cellular Corporation, an alternative energy company, the former chairman of Enercam, a leading biofuels company, and the chairman of the Canadian Federal Government Task Force on Low-Income Housing and Toronto's first housing commissioner. So without any further ado, Donald, if you could lead the conversation.
So, they didn't mic either one of you fellows, did they? So,
we'll get the mics.
okay. In the meantime, why don't you get up and I'll give you some room here.
I was asked to really do an impossible task, which is to explain the entire economy of the second largest economy in the world in 10 minutes. But I think I can do that. So we'll start. Is this the clicker?
Yeah.
Okay. The Cathay Funds, as has been said, was one of the earliest investors in the private equity space in China. And in fact, it was Paloma and Donald Sussman who sent me to China for the first time in 1992. And it was really his vision, before mine, of what China could be. Now, this is only 3 years after Tiananmen Square, so you have to really set your mind back to what things looked like back then. We hear today almost a steady drumbeat in the press about how, China's finished. It sounds, if you read the papers, it sounds like China's collapsing, et cetera, et cetera. But the reality is China continues to have the highest growth rate of any major economy. We hear a lot of people say, oh, but the numbers, you can't believe the numbers, et cetera, et cetera. First of all, the numbers, which I report here, these are not Chinese government numbers. These are Morgan Stanley's numbers. So these are not as if this is the Chinese numbers we're going to believe in. The Chinese government doesn't believe that it's underperforming. In fact, the growth rate in China today is almost exactly what the 5-year plan had predicted. You don't have to guess in China. They publish it. Anyone who reads Chinese can read the 5-year plan, and you know exactly what their plan is. And their plan was for roughly 7% growth. This year they did 7.3%. Anyone who spends a lot of time in China can see this. For example, you can look at the real retail sales growth, which I've charted there. We would die in North America for these type of growth rates. You can look at mobile phone subscribers. You can look at healthcare expenditures per capita. Or you could look at car sales. Any way you look at it, you can see on the ground where that growth is. It's not much of a surprise to anyone. The question is, where is all that growth coming from? So the first question I'd put out is, how many people does China have? How many people live in China? People might say 1.2 billion, 1.3 billion. That's wrong. China has about 650 million people. The rest don't count from an economic standpoint. But they're moving to the cities and to the cash economy at the rate of about 20 million people a year. That's like creating a brand new New York, Chicago, Los Angeles, and Houston every year. Every year. That's the growth in urban households that we see. And at the same time, we know that the average real wage in China continues to go up. Again, very, very much unlike in North America. In fact, the numbers just came out for 2014, and the nominal wage rate, income rate, basically growth, was 8%, which means a real wage increase rate of about 5.5%. That's the highest of any major economy in the world. It's that growing middle class that drives future consumption. Now, you can say that you don't believe the growth in China is what it is, but if the middle class is growing, which as we heard this morning was one of the things growing behind growing oil consumption, then how's that happening? If there's no growth, how's the middle class growing? In fact, we know the middle class is growing and that the middle class will continue to grow through the year 2020, at least. We can see that in two things. One, we can see the growth in urban household annual income, and the market that we sell things to today, we can see on the center of that chart, 2010, it's the 6% plus 2%. That's what we would think of as middle class, but you can see where that's predicted to go by 2020 under McKinsey's studies. McKinsey does the best consumer studies in China. And you can see that goes to about 56%. So what that means is by the year 2020, not only will China have the largest economy in the world, it will have the largest middle class in the world. And that has profound implications for everyone who wants to sell stuff. Okay. The thing that you have to understand about China, however, is that there are really two Chinas. There is the state-owned economy and there's the private economy. So when we started in business back in 1992, about 6% of the economy was private. 94% was state-owned. Let's fast forward to 2014, and the numbers are about 56%, 44%. The private economy has grown from 6% to about 56%. Well, what's happening here? If China's been growing on the average of about 10% a year, what that shows you is that a large percentage of that growth, virtually all that growth, has been on the private side of the economy. That's how it's gone from 6% to 56%. And in fact, we can see that in the numbers. So this chart shows revenue and profit growth from the state-owned sector compared to the private sector. And as you can see, the state-owned sector is underperforming. That's not a surprise. I mean, just imagine an economy where half of it consists of something that looks like the US Post Office. State-owned enterprises don't do any better in China than they do anywhere else in the world. But the private economy has been growing at strong double-digit rates. So if we talk about a 7.3% overall GDP growth rate in China, that's kind of misleading because it depends on what sector of the economy you're in. If you're in the state-owned sector, it's lower than that. If you're in the private side of the economy, it's considerably higher than that. And in our next segment, we'll talk about how to make money off of that.
Before Dennis gets up, it's worth mentioning that each one of the Cathay funds has returned 4 times the investor's capital. So Paul has been requested by the CIA to come instruct them about investing in China, and this is, an incredibly great opportunity for backing entrepreneurs, as you can see from the numbers. But anyway, please, Dennis, who has although I never met before, an incredibly impressive career.
A pleasure.
Thank you.
Okay, so after we've all been overwhelmed with multiple slides and charts, you'll be happy to know that my PowerPoint is 4 slides or 5 slides. Asked to speak about investing in real estate, and to spend the first 10 minutes telling you what I've done and looking back, partly I think is an antidote to some of the contagious optimism about the world's going to be fine for the next 3 years. Let's see if I can get this to work. So I spent the first 10 years or so teaching law, practicing law, government consulting, government task forces, and then wound up starting up the City of Toronto's housing department, building or producing 4,000 or 5,000 units, including the St. Lawrence Housing Project, along the bottom of downtown Toronto, from Union Station over to Parliament. That was my introduction to doing development and running an organization, and it had the great benefit for a developer of doing it all with other people's money. Federal government, provincial government, metropolitan, and out of reasonable success was recruited to join Olympia in New York to run a portfolio of 11 million feet that they had bought at the bargain price of $330 million, $30 a foot. I don't know the precise amount, but very little equity, a lot of debt. And we got there with perfect timing, the start of a stock market boom, a financial services boom. Downtown rents went from $7 to $35, and over the course of 5-6 years, the value of the portfolio went from up more than tenfold to in excess of $3.5 billion. Seeing the boom coming, we started the World Financial Center, 8 million square feet, completed in 5 years, 90% leased or occupied, or at least or committed before we completed the project. And so once again, able to double the value of that portfolio. And undertook another 8 million square feet of space across the United States. The net effect of that is 10 years after entering the US, the company, having hit the wave perfectly, had a net worth in excess of $10 billion. It then did 2 things as a result. It started Canary Wharf, of which I was the chief executive, and embarked on some corporate diversification. Canary Wharf, 5 million square feet, 10 buildings, started with great optimism, but the wave was cresting. And at completion, instead of 90% leased, it was 20% leased. And the diversification consisted of buying Cadillac Fairview, Trizec, Campo, Gulf Canada, and Abitibi Price, all in the interests of diversification. And when the economy turned, and much had been acquired with capital borrowed against existing assets, there was no money left to feed Canary Wharf, and $10 billion of investment came tumbling down. Let me step back a pace, should have said to begin with. Why invest in real estate? You invest for income, hoping for some income growth, and for a capital gain. You buy your money, you make your money by by buying well, by financing well, marketing well, and if you're not a long-term holder, by selling in time. And great fortunes, like Olympian York's, are made through the judicious use of leverage, and they're also lost through that leverage. And so what's going to happen to interest rates and what's going to happen to the economy becomes critical to the decision of whether to invest and what to invest in. Once Canary Wharf had cratered, I decided I would do smaller projects with partners for my own account with better control of the financial risk, but had learned too well the use of leverage. We undertook Festival Hall, I think it's now Riocan Hall, with the Scotia Theatre at Richmond and John. There started in 1997, started one of a couple of buildings in London, Broadgate West at the same time. Festival Hall, we had 10% equity, another 10% from the sale of a capitalized lease at the back end. Riocan prepared to buy a half interest on completion, and so we could get a loan with 10% equity. Broadgate West started with a £30 million loan from a German bank, and at completion of the two buildings with very limited further equity, the loan amount was finally £235 million. So hit the market right, limited leverage, you can make a lot of money. But with Broadgate West, we sold the first of the buildings perfectly in 2006. Second one we held on to. 2008, demand collapsed. Cap rates went from 5 to 8. Our loan was offside. We had a loan-to-value covenant we couldn't meet, and the bank kindly forbore to foreclose for a small back-end loaded £10 million fee for the forbearance. At the end of those projects, I'd come to the point where I really didn't understand what was happening with finance rates. I had a joint venture with Whitehall, with Goldman Sachs, to acquire prime buildings, office buildings in the Northeast. Those we bid on a couple that we didn't get and folded up in 2005 because we didn't understand how people could pay what they were paying. And we didn't understand why interest rates were where they were. Left some money on the table for 2 years, and then the crash came. And then I spent from 2005 to 2010 in a new development activity, biofuels. Cellunol, we wound up selling to BP, and the current company is at the point of running in its first biofuel plant. And there may be some investment opportunities for you there. We may be looking to raise capital by selling partnership interests in some of the plants that we're developing. I go through the history to talk about my view for the next segment, where we are now, whether the economic cycle matters, and whether we should simply assume that because of the factors that were raised, interest rates are going to stay there where they are, and therefore any real estate investment that you make is safe. Thank you.
Well, with that as background, I think we're here to get each of your views on where there are opportunities now. I will briefly repeat what I said. I think both bonds and stocks are very dangerous, and that's what typically people invest in. But let's hear about first what Paul thinks about the state of the world in China, which everyone loves to hate except Paul.
Except me. Fortunately, it's done very well. That's what. Okay. The question is, how do you make money on all this? If we could get the slides back, please. Okay. Whoops. Go back. Oh. Okay. This is sort of a truism. To make money at anything, you want to provide capital where the demand for the capital exceeds supply. That's where you're going to be able to get your best type of rates. In China, it's actually a nice setup because, as we mentioned in the first part, the fact that it's the private economy that's generating all the growth and producing all the value. At the same time, however, it's very difficult for private companies to get financing in China. The reason for that is the banks in China are all state-owned, and state-owned banks lend to state-owned companies. It's that simple. When it comes to the public markets, companies need approvals to get listed in China, and it's the state-owned companies that get the permissions. So consequently, you have the odd situation where the universe of listed companies in China are the worst performing companies, and the private non-listed companies are the best performing companies, and we can see this in this chart.
Let me interrupt for 1 second. So in China, just like every place else, unemployment is a problem. The way the government stays in power is by actually employing people in state-owned enterprises, whether they need them or not. Very early on in our career, Paul and I looked at a company that had 25,000 employees, and we went to the plants and we sort of, eyeballed how many people were there. We couldn't find more than 1,000. So it was a very early lesson, and there were more than 20,000 people on the payroll of this state-owned enterprise that didn't do anything. They just got a paycheck. So when those companies lose money, where they get the money to cover the losses is from the policy banks. So if you're your basic entrepreneur and you're starting up a new glass company or tire company or selling car insurance, the banks don't want to hear from you. They're busy financing the unemployment problem.
In fact, most of the money that we invest in China goes to working capital. But we do it at private equity rates. It's that mismatch that creates the outsized rate of return. I mean, imagine putting working capital at private equity rates. Now, this is my favorite chart because this goes to where you want to put money in China, right? And what kind of industries, what's the bet? So this is a map of China today. And what we're looking at is a country with a populated East Coast, those are the population centers, a rural West, lots of cheap labor, a big export engine, but a growing domestic consumer base, lots of natural resources, lots of government spending on infrastructure, and being financed largely with foreign capital. So we're talking about either China or the United States in 1900. It's the same model. So China is not Japan. It's not Korea, it's not Taiwan, it's the United States. And in fact, we have kind of a crystal ball where we know how the future of China is going to develop by simply looking at how the United States develops, and we can copy that. And that cuts down the risk, because whenever you know what the future is going to look like, that cuts down a lot of the risk that you would otherwise have. So we know two things. We know, one, put the money where it ain't. That is, where the demand for the money is the greatest. That's on the private sector, the fast-growing private sector. Don't put the money in the state-owned sector, because why compete with companies whose parent cost of capital is zero, coming from the government? And we know that in terms of looking for investment situations, what we want to do is we want to look for situations with reference to how the US or Canada, or actually Europe as well, developed during their stages of development. I'll leave it there for the next segment.
This segment we're going to talk generally, and then the next one specifically, right?
Yes, that's the idea.
Okay.
That's the idea.
So in terms of where you should put your money in real estate. We can be talking about asset classes, we can be talking about geography. In terms of asset classes, just drawing on some of the things we've seen from the earlier panels, there's been a flood of money released by fiscal repression, by the government, by the inability to get any return on money in the bank, and that money has gone everywhere. It's gone into stocks, it's gone into bonds, it's gone into commodities, it's gone into art, it's gone into real estate. And apart from the domestic liquidity, there's been a rush of foreign money, sovereign wealth funds, and emerging market safe haven money. Just get out of there before they take it away from you. And that money has flooded into office buildings in prime cities, in New York, in London, everywhere, all of the major cities in the United States, say. And it's driven cap rates down to a point where they make no sense historically. And I am bearish about the cities I've operated in, New York, London, because of what you heard about the financial services business. I had joint ventures with Morgan Stanley and Whitehall, and from 1995 to 2004, their staffing increased tenfold.
Wow.
And they can't take proprietary risk, and their syndication businesses disappeared and they're shedding people. And the hope is that technology and healthcare and education growth will replace that, but those are minor employers against banks that took 2-3 million feet. They're driving those markets, and there'll be some opportunities, but the opportunities will come when this cycle ends and when there's distressed property to buy. The same thing has happened in high-end condominiums, happening to a lesser extent here in Toronto, but in London, New York, in all of the world's commodity cities, in Sydney, in Oslo, in Vancouver, prices have gone through the roof. And all of a sudden, in several of them, they're starting to roll over. The money's going into those places as it had into offices in New York and London, because everybody knows you can't lose money in real estate. And you can't lose money in real estate in prime centers. And the reason for my historical exposition was, that ain't so, folks. I've been there. I had the privilege of announcing the $10 billion bankruptcy in 1992. That bloods you. The place that we like, and that I will talk about in the next segment, we like apartments. We like specialized retail. What we like about apartments was set out in the double line presentation. A shift from ownership to renting, young people doubled up in their parents' basements, tight credit markets, an inability to get financing, crippled by $1 trillion of student debt. So if you're going to move out of your parents' apartment, you rent. One other point that I would make about investing in real estate, you think of it as bricks and mortar, it's really a service business. It's all about bums on seats. It's about capturing population growth, employment growth, and providing space to accommodate that employment growth, the new people coming into work, the places that they're going to shop. We don't like retail.
Can we stop on apartments for a minute?
Yep.
So cap rates have gone down on existing properties also.
Next segment.
I think it's inappropriate. Just go for it, because I mean, people they're ready to write their check for your next real estate project.
So the reason, one other thing I failed to say in the introduction, the reason that you buy real estate is to make the cap rate on your investment, and then to use the leverage to make, call it a third, to make 6% on your investment and 2% on the debt, the spread between the cap rate and the debt. And cap rates are coming in, and you can still get, through creative financing, pretty close to that 2%. If you get 5 3/4 instead of 6, but you get 3 times 2 on the debt, and you're up over 10, and your investors are getting 9, 10% tax sheltered. We're right at the edge of where you want to go. The worry about cap rates isn't about earning your current return. It's about 3, 4, 5 years out. In our time frame, how do you get out? And the only way we can deal with that is by making sure that we're getting a very good deal against replacement cost, that we're buying for less than the current market in that area is, and we try to buy in high growth locations so that we're getting enough income growth that even if the cap rate moves against us, we'll lose some of the capital gain, but there'll be enough of the capital gain to make it worthwhile. But the basic thing we're doing is trying to get our investors half, maybe a little more of the total return they're going to get from current income, tax sheltered.
Can you give us an idea where you're finding specifically opportunities, what kinds of cities, what kinds of locations?
We got into it nervous, but we got into it in 2010. Slow growth, we didn't know where the economy was going, and so our first sense was we're going to be defensive. We want to be in the areas of highest growth so that if the economy turns against us, you'd still get enough growth to support your occupancy. So we want to be in energy, in places that are dependent on energy, technology, that have big universities, generally state universities, and have strong medical sectors, which are a sixth of the US economy. And so in a place like Houston or Dallas, we've done very well so far because the growth has been so strong. Income growth relative to income growth in the rest of the country is so strong that you can get 5, 6% rent increases.
Who are the sellers?
Well, you're taking my whole slideshow.
I'm here as your front man.
You're doing fine. We have been opportunistic buyers. We've done a little bit at auction, and that's hard work and not very successful. We've had funds who are at the end of their...
Auction meaning bank auctions?
No. I mean, a smart seller tells his broker...
Put it out to auction.
Put it out to the world.
Got it.
First buy was from the people who manage most of our properties, who had a fund that was in its last year of life. They wanted to sell. This is what we want. Hit the bid, we won't go to auction.
Right.
We've bought several from REO, real estate owned, that were being sold by institutions that had taken them back, repositioned them quickly, so put some money in, not done a great job of renting, filled them up. You can turn that around. We've bought a couple from REITs that year end, we want to sell our existing product and buy something newer. As opportunistic as we can be.
Okay.
One last remark.
To go back to Byron, it sounds like your being there for the bankruptcy of Canary Wharf has made you into a great real estate investor, if I may say.
We try. Let's talk about retail briefly, too, while we're at it. I'm not terribly enthusiastic about retail, and again, that was canvassed. We've got very limited middle income growth, and we've got horrendous competition from Amazon, from the big retailers going online themselves, from the tax advantage of no sales tax if you buy online. And so, buying an existing shopping center thinking the world is going to stay the same is a mug's game. We did buy a portfolio of shopping centers from Walgreens, anchored by Walgreens, 85% occupied. Walgreens was 2/3 of the revenue, 20-year leases. Well, that's that's the office business that I grew up with. If you've got 20-year guaranteed income stream and that same 200 basis point spread, you get a very nice return for your investors. But other than special situations like that, I'd be nervous of buying retail.
Okay.
Paul, where are you seeing opportunities?
Okay, again, let's go to specifics. If we could get the slides back one last time. This is the fun part of the presentation. Okay, so what are we looking at here? This is the view on a sunny day out of our conference room window in Beijing. You can hardly see across the street. Now, what are you looking at here? What you're really looking at is coal smoke. That's pollution caused by the fact that so much of the electricity and other uses in China is driven by coal. Now, China is not new in this problem. This is another picture, but it's not China, it's London in 1952. This is what was called the Great Fog of 1952. And it was driven by exactly the same thing, coal smoke. Now, and we have two pictures, actually. One is of a Londoner in 1952, and the other is of a Beijinger in 2004. We know how this story ends. As China gets wealthier, it needs to clean up its pollution. It's become a political issue in China, if nothing else. And the only way to clean up the air in a city as big as Beijing, for example, is to switch from coal to natural gas. That's what London did, and today London is one of the most pleasant major cities in the world. And we know that's where China is going. So what did we do? We went and we bought the pipeline, literally. We own the pipeline that services the industrial areas around Beijing. It was actually relatively cheap. We bought it on a multiple basis. The multiple was single digits, multiple basis. The Chinese didn't really understand where natural gas was going to go. We did understand where natural gas was going to go. And to us, this was a very, very low-risk type of investment that was simply going to play out the way it's played out in all other major cities of the world. Pittsburgh would be another one, where they switched to natural gas from coal, and that cleans up the air. The result of these type of investments, this is not the internet stuff you read about, this is not the flamboyant, this is not Alibaba. This is very, very simple kinds of investments, very conservative investments. And the idea is to make a return on a portfolio basis. So this is the returns that Donald was talking about earlier. These are the 4 funds that we've done. And, as you can see, this has been very, very good. In effect, we've been the Hyman Roth of China investors. We always make money for our partners. And we do that by not trying to be heroes, but simply by going back to tried and true types of investment thesis that have proved themselves in the West, and simply applying that to the next fast-developing economy, which is China.
Why don't you give an idea, a couple of the key companies you own now that are still part of the portfolio?
Sure. As a part of the portfolio, things we've invested in and continue. We've invested in the past. We invested in China's largest fashion magazine. I mean, people don't realize China has fashion. Sure, they have a large fashion magazine. We know how magazines grew in the United States in the 1980s and 1990s. It was very fast growing. We gave the company the capital they needed to expand, and then we turned around and we sold it in a trade sale to Bertelsmann. We like trade sales. You get paid in cash. There's something very nice about that. So we try to do it whenever we can. We invested in China's largest independent financial services company. Financial services were a huge growth business in the United States in the 1980s and 1990s, and it's proving to be exactly the same thing in China. We invested in a company that made telecom equipment. sort of expendable telecom equipment. Well, we saw earlier, I had up the chart, what the growth in mobile phone usage looks like in China. It's the proverbial hockey stick. So we're basically investing in companies that are selling into that consumer demand. And in China, it's all about, it's about infrastructure, it's about consumer demand, it's about all the kinds of things that were growing in all the same kinds of ways that they grew in the United States and Europe over the last 20, 25 years.
Where are you seeing opportunities, Dennis? Do add your biofuels company, which is sort of the sideline.
So interestingly,
Was I again your straight man? Did I get you the
yes,
right?
I was speaking
For
about
not
China.
practicing, we're doing well.
The company's called Enerchem. The chief executive 2 weeks ago was in China talking to the Shanghai and Beijing authorities. We take municipal solid waste and turn it into methanol or ethanol, and separate apart from natural gas, people pay $40, $50, $70 to have their waste transported, buried in a landfill where it produces greenhouse gas. This recycles the carbon, turns it into fuel.
Is it a patented technology?
Oh,
Okay, good to know.
China has a tremendous amount of solid waste. It's a very funny story, but I was out in a place called Changsha, and they took me to this beautiful valley, you know, something out of Crouching Tiger, Hidden Dragon, whatever it is. And the mist is on the mountains, and I said, well, what are you going to do here? And they say, well, we're going to fill it up with garbage and cap it in 6 inches of concrete. I said, how can you do that? This is the most beautiful place I've ever seen. They said, well, it's no good to us. You can't farm here. You can't build a factory here. And they had a little model of the mountains with a little concrete cap down, how it's going to fit on top. So that's definitely a growth area in China.
Can I get my slides back? I'll just show you one. And also I want to draw back to what's running, the theme that's running through many of the presentations, on which my position is contrary. And it's going back to what I said about how you make money, the spreads, leverage, and that's the Fed and interest rates. Sorry, how do you go backwards? Okay, let me just keep going. This is our track record. We got in early. We bought 4 buildings in Dallas, which we've sold, 1 in Houston, which we've sold, 1 in the Bronx, which we bought just because we bought it cheap. And with the current mayor reacting to political pressure and putting a lid on rent increases, we can't make our projections, and we can get out with a very good profit for our investors, so we're doing that. Because of the spreads, we're producing 9-10% returns for investors. We're focused in the Washington-Baltimore corridor, where we'll do very well because that market at the moment is overbuilt. You've had the federal government not holding down the employment base, but given everything that's going on around the world, you're going to start to see the defense budget increasing and cyberspace warfare expenditures increasing, and employment will pick up in Washington. The overhang will go away. That's a very good place to be. We're looking at further acquisitions in Atlanta, in Raleigh. We bought one recently in Houston. You've got to be where the growth is, and that's what's going to protect you on the downturn as well. I want to go back to...
Could you just describe a typical deal you've done recently so we get the order of magnitude? This is a 50-unit building, a 500-unit building, it's a...
They're generally 250 to 400, 500. They're in a range of $40 to $60 million. The equity is with your closing costs, et cetera, it's somewhere around 25%. The debt is 75. After everything I've said about how leverage can bite you, we're still prepared to take that leverage because we're talking about 2-bedroom units that run from $1,000 to $1,500. It's gray to lower white collar. They've got to have some place to live. Even in the worst of the downturn, they went down to 90% occupancy, 88. You could in a recession have a dip where you lost 5, 6, 7 points of occupancy and you couldn't make distributions for a year. But we saw even after 2008, the occupancy bounce back fast, and then a year or two later, you were getting decent rent increases. The thing that I think we need to focus on, I mean, because I was listening to the presentations, not only as an apartment asset manager, but as with some of my separate silos, an investor. And I just don't believe that you've got the assurances that we got from most people. Interest rates are going to stay there. The government's boxed in. They can't afford to pay more on the government debt. Competitive devaluations for 10 years at least, until it just repressed rates totally. The Fed was constantly behind the curve. The market drove rates, not the Fed. And I just don't believe that there's no inflation. I'm the one in my household who buys meat and buys milk, and no inflation, 25%. Now, that's not in the CPI. Plus, the American measurement of the CPI was jiggered in the 90s, so that if you measured it the old way, it would be 3 or 4% today. That was done to hold down Social Security and pension payments. Other games with hedonic deflators. There's more real inflation there. And if we get 3 million jobs created over the next 12 to 15 months, you're already starting to see wage pressure when you're seeing real wage pressure in the energy industry, which is booming and has to hire skilled people. You're seeing it in the technology industry. I've got a friend whose son-in-law is working in a New York tech firm along with 3 or 4 other Canadians who are down there because the firm can't hire. And because the American immigration program is so benighted compared to the Canadian, that there are specific areas, anyone skilled, the employment market is really tight. You're going to see wage inflation, and the Fed's going to hear all of those arguments we heard, and you're going to hear about the dual mandate. Byron was sitting there saying, no inflation. I don't believe it.
So I think it was Byron who talked about Seth Klarman from Baupost. Just, as a matter of interest, he's in 40% cash. So for all of those people who are so complacent like Byron, obviously he's a man with an incredible 25-year track record of being a great value buyer of assets. He's not very complacent. He would confirm your view, my view.
2 other quick points.
Yep.
You want a real, housing ownership opportunity. Slightly biased, although with no economic interest. I sit on the board of a Toronto firm that's building housing here. If you want to invest in new housing production, do it in Canada. Don't do it in the States. After we get a mild correction because it's slightly overbought. We've got 250,000 permanent visaed immigrants. You've got another 250,000 Gastarbeiter. You've got an inexpensive city to live in relative to world cities. You've got really good airport transportation. You've got the strongest banking system in the world. Rental apartments you can't buy here, but investing in building housing, smart. A number of people out there I know are invested with Greywood, which is the name of the company. They're going to be raising a new fund. It's something people should look at.
Now, here's the interesting thing that's happened in the world. If you look at it from a strictly economic standpoint, where's the safe investment today? Well, what country has the lowest amount of debt compared to GDP, the lowest amount of consumer debt compared to GDP, has increasingly affordable real estate, increasing wages, and low inflation? It's China. Now, no one thinks of China as on the safe side of the investment spectrum. But when you look at what's going on in the United States and Europe, you say to yourself, there's an argument for that. There's an argument for that.
That's because they repressed wages for 50 years, and that's going to stop.
They aren't repressing wages now. Wages are growing very, very quickly. In most cities in China, there's a labor shortage today.
So with a shift to domestic consumption, those wages are going to feed through into inflation. That's where you start to wonder about the statistics.
I think the inflation that they're experiencing in China today is very modest. They have the same experience we do. That is, they personally feel that prices are going up, even though the government is reporting relatively low numbers. I would say that the situation is very similar to the United States.
They're also very helped by a strong U.S. dollar, as long as they can hold the peg.
Yeah. Are we supposed to be permitting questions here too?
Yeah.
I don't want to be the only one asking questions, but I'm happy to keep asking questions.
Just ask, as an individual, when I watch 60 Minutes and they do a segment on the apartments, cities of apartments that are empty.
Ooh, were you a plant? That's Paul's favorite question.
That's my favorite question. Okay.
I'm just an individual, so when I look at it, I go out of there going, oh my God.
Okay.
There's going to be a collapse, there has to be, because who builds cities with nobody in them?
Okay. Here's the interesting thing. This is nice because it puts together real estate and China actually puts a thing. The Chinese development model is very different than the American development model. So the Chinese development model is all planned cities. It's basically, if you build it, they will come. So what happens is the Chinese government will give approval to a developer. The developer will go and build this project, and then the project will fill up over time. Some years ago, so you have two different segments. You have the residential segment and you have the commercial segment. Let's talk about the residential segment first. In major cities, the average mortgage rate is less than 30% on value. In tertiary...
That's the debt.
Debt. In secondary and tertiary cities, it's zero. You can't get mortgages. Apartments are bought for cash. You simply don't have crashes in value where people have paid for apartments in cash. There's no pressure to sell. Zero. There's no defaults, no pressure to sell. On the commercial side, most of the developers of commercial real estate in China are state-owned. And you know what happens if a state-owned developer can't repay his debt to a state-owned bank? Nothing. They roll it forward. So some years ago, I was in Pudong, which is the new city built across the river from Shanghai. And it looked like Fort Worth in the 1980s. There were all these empty buildings. So I said, this is great. We're going to buy these things all at a discount. We're going to make a fortune. We sent a team to Pudong. They stayed there for 6 months. You know how many buildings they could buy? Zero. No sellers. And today, the occupancy rate in Pudong is 99.5%. So what happens in China is they sometimes get a little ahead of themselves. And when they get ahead of themselves, you have some empty apartments. They're not ghost cities like you read about in 60 Minutes. The one city that they go to is a place called Erduz up in Inner Mongolia. Erduz is a place that got fabulously wealthy because of minerals that were being extracted. And you created a whole class of people that remind me of the Beverly Hillbillies. And what do those people do? They invest their money where they know, locally. And what they invest in real estate because they think it's really safe and you can't lose their money. You can't.
And they pay cash.
And they pay
100% cash.
It's 100% cash. So those projects are not defaulting.
A couple of questions about that.
Yeah.
My reading, a lot of those apartments are multiply owned by individuals who bought them because they trusted real estate, which only goes up more than they trusted the stock market, wisely, because of manipulation. And the cities survived and paid for services by selling land. And as they mature, and as you get to the point where housing is too much of GDP, they're not going to be able to raise their revenue that way. They will go to the same direction as most of the developed world does. They don't have a property tax, which means the cost of buying one of those houses as an investment, you don't get any return on your money, but you don't reach into your pocket and spend any money. The houses would be tainted if they were rented out so that by and large, unlike the Chinese who come to Toronto and rent out condos for 3%, those aren't rented out. And as that world changes, and as people again decide, oops, maybe there's a dip and maybe you could lose money, you could get some liquidation. That market will not be as safe going forward as it is now.
Offsetting that, you have 20 million people a year moving into the cities, and you also have an increasing wage level, which gives people income to buy houses.
Well, but the treadmill.
When you said multiple, units, a very high number of units is 3.
Yeah, 3
It's not. It's not like the firms that went out and bought up tens of thousands of empty houses and are renting them out. You have an individual successful entrepreneur who pays cash for a second unit or a third unit. He pays cash. So our mindset of leverage and it's empty is completely different.
No. But you may find for superior investments, particularly if you start to see housing prices coming down, people liquidating that and saying, I'd rather put my money here, or I'd rather get my money offshore before they come after me.
They can't do that. That's one of the reasons it is safe there, is
they're
Chinese
frozen in
currency
place?
is not convertible. So they have a very limited number of things they can do with their money. They can buy gold, they can leave it in cash in the bank, or they can buy real estate. That's it.
Well, until recently, unless they sent it to Macau and the central government didn't look.
I mean, people can always do illegal things, but the total leakage out of the Chinese system is relatively small, given the size
And
of
the
the
last
economy.
time I looked, they were investing $20 billion a year in North American real estate,
which
the Chinese.
which is a small number for the second largest economy in the world. It's all relative. It's all relative.
Did I see someone? Is that a question or you're? Please.
A lot of what's happened in China has been with this backdrop of long-term growth.
Yeah.
But there is a lot of talk about both.
You have a microphone right next to you.
Sorry. Both the status of foreign investors and the legal system under which they operate. You've had court cases in China in which they say that the variable interest entities are violations of Chinese law. How comfortable are you that your position as a private equity investor in China is protected? How do you protect yourself, and are you worried that you'd be subject to a certain amount of caprice in the event that there was some kind of a cyclical bump in the Chinese economy?
Okay. It's a fair question. What we tend to do is we tend to protect ourselves not based on going to court, because even in the US or Canada, you go to court, it can take years for you to be able to enforce your rights. What we use greed and self-interest. So we are minority investors typically. The entrepreneur is usually a 75, 80% owner of the business, and we make sure that our interests are completely aligned. That's our first line of protection. If things go badly, you do have recourse. The recourse is slightly different. Very often the recourse is political. So for example, in one of the situations which we had in the 90s, we had a state-owned company, which we invested in before we learned you don't invest in state-owned companies, and they had cheated us. So we went and we complained to the government. Zhuangji was premier at the time. And Zhuangji forced the government of the province to basically take us out at a reasonable profit. I'd like to see you go to Texas and ask them to do the same because of Enron. It doesn't happen. So there are other means of redress in China that are not exactly the way we think of them. On the whole, China's not as well developed. I think of like the way the US was in maybe the 1920s. But it's developing quickly. And the big confab that they had only 2 weeks ago in Beijing, the whole theme of that was rule of law. And they know it has to develop. It's not going to happen overnight. But it is not the Wild West, as some people portray it, where foreigners are simply, put to the knife if something goes wrong. The government understands that it requires foreign capital, and that it's been foreign capital that has been developing China, just as it was French and English and German capital that built the United States. And they know that if foreign capital is treated poorly, it won't come.
That's a really important point. I mean, we have had the real-time experience of going to the government. They recognize that we are respected and recognized investors, and if we spread the word that we were cheated and not redressed, the government is very concerned about it.
Well, thank you, gentlemen.
Thank you.
This was a fascinating conversation.